You buy a laptop for your business. Simple purchase, right? But here is the question most business owners get wrong. Is that laptop an expense or an asset? Because if you record it the wrong way, you could be paying thousands more in tax than you actually owe. Today we fix that. This is assets versus expenses, the most misunderstood concept in accounting. Most people think like this. I spent money, therefore I have an expense. And honestly, that sounds completely logical. The problem is, accounting doesn't work that way. Every single payment your business makes is either an asset or an expense. And which one it is depends on one very specific thing. This distinction directly affects your profit, your taxes, and how your business looks to a bank or investor. Most small business owners don't know this. After today, you will. Think of it as two buckets. Every payment falls into one of them. Bucket 1. Assets. These are things your business owns that will generate value for more than 1 year. A machine, a computer, a building, a vehicle. They live on your balance sheet. Bucket 2. Expenses. These are costs that get consumed immediately or within the current year. Rent, salaries, electricity, office supplies. They live on your income statement. And the key question, the one you need to remember, is simply this. Will this purchase provide value beyond 1 year? Now, not all assets look the same. There are 3 types your business will encounter. First, current assets. These are converted to cash within a year. Think cash itself. Inventory you plan to sell or money customers owe you. Second, fixed assets. These are used over many years. Equipment, vehicles, buildings, computers. This is where most people make mistakes. And third, intangible assets. No physical form, but very real value. Software licenses, patents, your brand trademarks. Today, we are focusing on fixed assets, because that's where the most costly errors happen. Let me make this real. Meet Martin. Martin is opening a coffee shop. On the very same day, he makes 2 purchases. First, an espresso machine for 5,000 euros. It's going to be the heart of his business for the next 5 years at least. Second, coffee beans for 200 euros. He'll go through those in about a week. Same day, same money leaving his bank account. But in accounting, these 2 purchases are treated in completely different ways. And here's why that matters. To be recorded as an asset, a purchase needs to tick all 3 of these boxes. 1. Ownership or control. Your business owns it, or at least has the right to use it. 2. Future economic benefit. It will help you generate revenue in future periods, not just today. 3. Measurable value. You can reliably put an euro amount on it. Miss any of these 3 and it's probably an expense. The espresso machine ticks all 3. The coffee beans, they're consumed in days, so they fail number 2. Alright, quick quiz. I want you to actually think about this one. Which is the asset and which is the expense? Option A, the espresso machine, 5,000 euros. Option B, the coffee beans, 200 euros. Pause for 5 seconds if you want. Think about the key question. Which one provides value for more than a year? The answer is on the next slide. The espresso machine, asset. It goes on the balance sheet. The coffee beans, expense. They immediately reduce Martin's profit. Now, why does this actually matter for your business? 3 reasons. First, profit. Every expense you record reduces your net profit in that period. Second, taxes. Wrong classification means wrong tax calculations, and that can go both ways. Overpaying or underpaying. Third, your financial reports. When a bank decides whether to give you a loan, or when an investor looks at your business, They read these numbers first. Getting this wrong changes how your entire business looks on paper. Let me show you exactly what I mean with real numbers. Martin has 20,000 in revenue for the month. He has 8,000 in other expenses, and he bought the espresso machine and the coffee beans. If Martin records the machine as an expense, which is the wrong way, his net profit comes out at 6,800 euros. But if he records it correctly as an asset and only takes the first year of depreciation, 1,000 euros, his net profit is 10,800. Same business, same cash spent, 4,000 difference in reported profit. That's the difference between a business that looks very profitable and one that looks healthy. Here's the second most common mistake I see. People confuse repairs with upgrades, and they record them the same way. They are not the same. A repair keeps an asset working as it did before. You fix a broken machine, repaint a wall, replace a flat tire. That's an expense. Record it immediately. An upgrade improves or extends the life of an asset. New engine, an extra floor on a building, adding RAM to your server. That gets capitalized. Record it as an asset. The question to us is simply this: does it restore or does it improve? So we have established the espresso machine is an asset. But here is the thing: it doesn't just sit on the balance sheet forever. Over time, assets convert into expenses through a process called depreciation. Martin's 5,000 machine is going to be used for 5 years. So each year, 1,000 of its value moves from the balance sheet onto the income statement as a depreciation expense. Year 1, 1,000. Year 2, 1,000. All the way through year 5. Total, 5,000. The cost matches the years the machine actually generates revenue. That's the whole point. There are actually two main methods of depreciation, and your accountant will choose which one fits your business. Straight line is the simple one. You expense the same amount every year. Predictable, easy to track. Accelerated depreciation front loads the cost. You take more expense in the early years and less later. This gives you a lower tax bill upfront, which can be useful for cash flow. Both methods add up to the same total over the asset's life. The choice is a tax and accounting strategy decision. That's what your accountant is for. So how do you actually use this starting tomorrow morning? Before you record any purchase in your accounting software, ask yourself one question. Will this provide value for more than 1 year? Yes, it's an asset. Record it on your balance sheet. No, it's an expense. Record it on your income statement. That's it. That single question is your filter. Computer, asset. Car, asset. Building, asset. Rent, expense. Salary, expense. Electricity, expense. Run every purchase through that question. Let's test it. Here are 5 things a business might buy this week. New laptop for 1,200 euros. Asset. Used for 3 or more years. Office coffee subscription at 45 euros a month. Expense. Consumed every month. Website domain for 3 years. 90 euros. Asset. It provides future benefit for 3 years. Printer paper 30 euros. Expense. Used immediately. And a logo design for 500 euros. This one trips people up. It is an intangible asset. Your logo has ongoing brand value beyond this year. How many did you get right? One last thing before we wrap up. And this one saves a lot of headaches. Even if something lasts more than a year, you don't always have to capitalize it. Most businesses see what's called a capitalization threshold, a minimum amount, typically somewhere between 500 and 1,000 euros. Anything below that limit gets expensed immediately, even if it technically lasts for years. A 40 euro stapler that lasts 10 years? Still an expense. Nobody's capitalizing a stapler. The practical rule: lasts more than a year and costs more than your threshold. Capitalize it. Anything else, expense it. Ask your accountant what threshold your business uses. We have covered a lot today, but if you remember just one thing from this video, let it be this. Assets work for you in the future, expenses are the cost of today. Read that again. Assets work for you in the future, expenses are the cost of today. That's it. That's the whole concept. The cheat sheet with all of this is linked in the description. Download it. If this was useful, subscribe, because the next lesson is the balance sheet explained. You will learn how to read a balance sheet and what it actually tells you about the health of a business. See you there. I'm Danny A from Accounting 123. Accounting explained for real people.